Hello, I'm Silvia Maru, correspondent at CNBC International, and I'm joined by Fabio Natalucci, Deputy Director in the IMF's Monetary and Capital Markets Department, and Andrea Deghi, Financial Sector Expert in the same division. Hello to you both, and thanks for joining us. And we're here to talk about recent changes in commercial property and what these might mean for financial stability, because it's clear how the pandemic has been hitting this sector. Stores had to close out of a sudden. People began to work from home. There was a lot more online shopping as well, and all of these changes have raised questions about prices of commercial property and how the sector might become different as a result of the coronavirus. So, Fabio, I would like to start with you and asking you first and foremost, what have you witnessed in terms of transaction volumes and price growth?
Yeah, so the commercial real estate has been one of the hardest hit sector by the pandemic, and you can see that in transaction volume prices and also credit quality in some sense. So maybe starting with transaction, there was essentially at the global level a decline in CRE transaction volumes about 40% globally at the trough in the second quarter. And some regions were hit even harder, so North America and Latin America, for example. Now things have improved, particularly in Asia, but we are still seeing the signs of the pandemic there. We also look at prices. We look, for example, at city level prices, so 64 cities across 11 economies. And you can see a very significant heterogeneity in terms of price impact. So, for example, prices have declined notably in Canada, but they have increased in some French cities. Among largest cities, the hardest hit were London and New York, for example. And that probably reflect different measures in terms of containment, how stringent they were, when they were implemented, as well as work mobility across different cities. That segments have been also affected differently. So segments like retail, hotel, offices has been hit harder than other segments. And you can see also, if you cross essentially cities and segments, you can see that in different cities, retail have been hit harder than others. Part of it is conjunctural, so it reflects the conjunctural nature of the pandemic shock. Part of it could also be structural in some sense. So we don't know when we get out of the pandemic, whether there are going to be changes, for example, in which we conduct purchases, whether we're going to go back to brick and mortar retail, whether we continue to use e-commerce. Same for offices, right? So whether we continue to work from home or whether we're going to go back to actual offices. And then finally, in terms of credit quality, we have seen the delinquencies rising, particularly in the structured product like commercial CMBS. The level of delinquencies is comparable to the financial crisis, but we've seen very large spike in delinquencies, particularly for those sectors that have been hit more harder by the crisis.
Of course, and actually I want to ask you, Andrea, how important is commercial real estate to financial stability? What is the link there between the two?
In a nutshell, the sector is relevant for financial stability mainly for three reasons. So first is because of its large size. Second, it heavily relies on the debt funding, and also is strongly interconnected with other sectors of the economy. So when looking back at the past crisis, in fact, commercial real estate sector has been, we saw a source or amplifier of macrofinancial shocks. You can see these, for example, in the Swedish financial crisis of the early 90s, during the US savings and loan crisis of the late 80s and early 90s, or during the GFC. And as well as in the Irish banking crisis of 2008-2011. A key channel through which the commercial real estate sector affects financial stability is through bank solvency. Banks indeed are the largest source of debt funding for the sector, and representing generally over 50% of the debt financing for the sector across regions. That means that a downturn in the commercial real estate market has the potential to worsen first, the credit quality of banks' borrowers by affecting, for example, the strength of their income streams, or in general, the strength of the balance sheets. So if this leads to borrowers' defaults, then banks can potentially incur very large capital losses, in turn reducing their lending to the economy, and in extreme cases, even to the bank's defaults. This was the case, for example, in the United States during the global financial crisis, when the failure rates for banks with high levels of commercial real estate exposure was 3-4 times higher than other banks. So far, the banking sector has shown resilience, but in our analysis, we show that severe adverse scenarios going forward could entail still significant capital losses for banks, especially with higher commercial real estate exposures. Another relevant channel between commercial real estate markets and financial stability operates through the significant exposures of non-banks institutions, which have a large exposure, in particular in commercial real estate debt and equity. So in principle, when the value of assets held by these investors falls, they might become less willing or able to provide new financing to commercial real estate borrowers, in particular when their balance sheets becomes weak. An important element to consider here is the role also of the non-banks as foreign investors. On the one hand, foreign investors and cross-border flows can increase the liquidity and risk sharing. But on the other hand, they can also increase financial stability risks by amplifying, for example, boom-bust cycles and the synchronization of prices across markets. Most of cross-border investments originate indeed from non-banks, which tend to be quite fickle in the face of large global shocks. In fact, what we see in the data is that in economies with a larger share of cross-border investment in the pre-pandemic period have experienced the largest contraction in overall CRE activity during the pandemic crisis. Finally, there is also an important policy dimension of this problem. So the larger cross-border interactions and the fact that non-banks are playing a growing role in the market make overall risk and policy assessment more challenging. And the reason of this is because non-banks are generally less regulated than banks and can increase the potential for circumvention of policies.
The reason why I ask you, Andrea, to clarify the link between the two is because you say in your research that overvaluation has now emerged in some economies. Could you clarify where have you seen that?
So let me start first by observing that commercial property prices increased in the run-up to the pandemic quite substantially for some economies. If you look, for example, in Sweden and the United States, the real commercial real estate prices almost doubled between 2009 and 2019. But does this mean that they were overvalued? The answer actually to this question is not that immediate. So in fact, different measures will tell you different stories. If you look, for example, at capitalization rates, which is the ratio of net operating income to commercial real estate prices, what we find is that it reached its lowest level since the global financial crisis for many economies, which would suggest, in principle, some overvaluation in commercial real estate prices. If we look, however, at the same measure as a spread or difference over the respective government bond yield, this has remained actually within a narrow range in the run-up of the pandemic. And for that reason, it wouldn't provide much evidence of stretch valuations, at least from an historical perspective. So since the different measures seem to suggest a quite different evolution of prices, one of the main contributions of our work is to put forward a more formal approach to assess commercial real estate price evaluation. Specifically, what we try to do is to determine whether actual commercial real estate market prices differ from the value implied by economic fundamentals, or simply put, the factors related to the macroeconomic environment, like the level of aggregate demand, interest rates, or also expected net operating income of these properties. So based on our model, we don't see much of a relation before the pandemic in our sample of countries. Though I must note that here our sample is limited because of some data limitations. But in the aftermath of the pandemic in 2020, we find that prices have become somewhat overvalued. This was largely reflecting the drop in fair commercial real estate values, following especially deterioration in underlying fundamentals like aggregate demand and net operating income. A word of caution here is due though. So a definitive assessment of price evaluation is in general extremely difficult given the extraordinary nature of the shock due to the pandemic and also the uncertainty that is still surrounding the pace of the recovery. And why is this relevant for financial stability? So we already mentioned that an adverse macroeconomic or financial shock can exert in principle a downward pressure on commercial real estate prices. And the problem is that this pressure is more intense in the presence of underlying vulnerabilities in commercial real estate market. In particular, a higher level of valuation is a primary source of such vulnerability, since higher overvaluations implies also potentially sharper fall in prices in the future. In our recent analysis, what we show indeed is that price overvaluation magnifies the downside risk to GDP growth, which is the future GDP growth in the most severe possible outcome. For instance, 50 basis point drop in the capitalization rates from its historical trend, which is, again, a commonly used measure of evaluation, has the potential to rise downside risk to GDP growth by 1.5% percentage points in the short term over 1 year, and by 2.5 percentage points in the medium term, so over 3 years.
Right. I would like to go back to you, Fabio, because I would like to dive into the risks here. Because back when we were at the global financial crisis, the shock initially came from the residential market. So I was just wondering, could commercial real estate spark a financial shock as well?
Yeah, I think this is a very important question in the sense that allows us also to learn to see what we have learned from the global financial crisis in terms of resilience of the financial system and how the system has performed through this crisis. I think there's two important differences between now and the GFC. One is the nature of the shock, right? So there was a financial shock, if you want, right? It was at the core of the strike at the core of the financial system, the banking system, and then through different channels propagated to the rest of the financial system and cross-border across countries. This is a different shock. This is, if you want, a real shock. It's still global, originated in a specific part of the globe and spread over the globe, but it's a different kind of shock. It's not a financial shock. The second important difference is the policy response, both in terms of speed, so how quickly policymakers have responded this time, and also in terms of scale. So the scale of monetary policy, fiscal policy has been massive. So if we look at like numbers, for example, price decline, we have that this year at the global level, the decline is about 4%, which is about half of the 7% or so at the trough during the financial crisis in terms of commercial real estate price decline. Now, that said, the impact, again, on specific sector like retail, hotels, that had been much larger in terms of net operating income that Andrea was mentioning before. So I think we want to keep three factors in mind here. One is the policy response. Again, there's been massive policy response, including both monetary policy, the G10 central bank has balance sheet assets are growing almost $10 trillion, for example. One has been the timely, how quickly central banks have responded. Also, importantly, fiscal policy has been part of the answer here, right? So if we think in terms of like mortgage relief, rental assistance, eviction moratoria, and fiscal and financial policies as well. So point number one is the policy response. Point number two is that the banks came into the crisis here with much higher capital buffer. So that allows them potentially to absorb losses, should some losses in the commercial real estate sector materialize, but also having more breathing room in terms of covenants. Point number three is the CMBS market, right? That played an important role during the crisis. If you remember when people start doubting the securitization markets as a whole, that became the freezing up of those markets became an important transmission channel of the shock. In this case, we came into the crisis with a CMBS market is smaller than it was back in 2007, 2008. It was obviously affected. We have seen issuance declining and spread widening at March during the March turmoil, but the sector is smaller. Number two, has benefited from policy reforms post-financial crisis. So it's less opaque, risk retention measure has been put in place. And then the policy response, right? So the Federal Reserve stepped in very quickly, purchasing agency CMBS, and also through other facilities as well, other measures more broadly supporting the sector. Now, going forward, I don't think we are out of the woods yet for a couple of reasons. One is that historically, if we go back to the financial crisis, there was a difference in times between how equity markets, for example, reacted to the financial crisis. So they dropped sharply and they recovered in 2008. But realization of losses in the commercial real estate took longer. So that's point number one. Two, there's a huge amount of uncertainties about the outlook, the economic outlook. So understanding what is conjunctural here and what is going to be structural is going to be crucial in some sense.
I would like to ask you, Fabio, as well about what policymakers can do to address these challenges, because you mentioned there how we're not out of the woods yet. So what else is out there for the policymakers to do at this stage?
So I think it's an important point to start is that continued policy support is crucial here to keep financial condition easy, help essentially bridge to the recovery, and maintain the flow of credit to households and firms. That's point number one. Now, of course, there may be also some possible unintended consequences of very easing financial conditions. There could be building up of vulnerabilities, interaction of reassessing of commercial real estate prices that Andrea was mentioning with underlying vulnerabilities, right? So it's important, maybe I would distinguish three possible steps. One is the use of targeted macroprudential policy tools, like loan-to-value ratio or debt service coverage ratio. That can be used and deployed by a policymaker to essentially address some of these vulnerabilities that might be rising in the commercial real estate sector. Now, there are obviously differences in terms of timing. So they may require different timing of the deployment, of the swift deployment of this macroprudential policy tool across different countries, because they may be in a different phase of the economic recovery, because the underlying vulnerabilities themselves may be different. The second one is banks. As I said, banks enter the pandemic crisis with much higher liquidity and capital buffer, but it's important to make sure that banks stay healthy and remain resilient. So one possibility is to use stress tests, for example, to assess the level of capital at banks in case there is a shock that affects the commercial real estate sector. Then step number three has to do with what we call non-bank financial intermediaries. So Andreas had mentioned these cross-border flows. It's important to know that NBFIs are playing a larger role in the commercial real estate market, including cross-border flows. And so it's important to make sure that the reach of the macroprudential policy perimeter is where it should be, whether there's a need to expand the perimeter and whether we have the right tools to address this. And I think some of this work the IMF is actually doing, participating in the work of the Financial Stability Board, where we play an important role in looking into the role of NBFIs during the March turmoil.
Absolutely. Well, this is a very dynamic sector to look at. And there are, of course, questions as to how the COVID-19 trends might become a permanent feature when assessing the stability of commercial property. So thank you to you both for joining us. And of course, to all of you out there who also joined this conversation. The IMF's Global Financial Stability Report is out on April the 6th, and you can access that on the IMF's website for more information. And for now, goodbye.
Thank you very much.
Thank you.